Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Sigma Lithium.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis of Sigma Lithium. We are diving into a bit of a paradox today.
A paradox. How so?
Well, the broader lithium market has been challenging, let's be honest. It's been brutal for a lot of companies.
Right.
Yet the narrative we're seeing from this company is one of really aggressive operational execution. They are shifting and shifting fast from that high-risk build-out phase to being a reliable cash-generating producer.
And that's the core question for you, the listener, isn't it? How does a company in a depressed commodities sector suddenly start showing this kind of extreme momentum?
Exactly.
We have to figure out if the stock has genuinely moved past that riskiest, most capital-intensive growth phase. Because if these financials are real, they've hit a pretty undeniable inflection point.
They are. The numbers absolutely reflect that transition.
Yeah.
We just look at the third quarter of 2025.
Okay.
Net revenue jumped an incredible 69% sequentially. That's quarter over quarter.
Wow, 69.
And it was also up 36% year over year. That kind of acceleration suggests they're executing perfectly on two key levers: volume and pricing power.
Let's break that revenue jump down then, because a 69% sequential increase, you usually only see that in tech startups, not in major miners. What was driving the volume?
Okay, so on the volume side, they sold 48.6 kilotons in Q3. That's a 21% increase from the quarter before.
Which is solid on its own.
It is, but the context here really matters. See, earlier in the year, the company made a very strategic call to intentionally withhold some product.
Right, when prices were in the basement.
Exactly. They refused to sell at fire sale prices. So Q3 showed them successfully getting those volumes back into the supply chain, but at much better prices.
Which brings us to the pricing side. You said better pricing. How much better are we talking?
They realized an average price of $586 per ton in Q3.
586. Okay.
And that figure is so critical because it's a 40% jump from the 419 they were getting in Q2.
A 40% jump in a single quarter is stunning.
It is. And it's not just a nice bump. It signals two things. First, that withholding strategy paid off. And second, they have serious commercial leverage to even a modest recovery in lithium prices.
But hold on, is that sustainable? A 40% price jump? Was that a one-off, maybe a specific high-quality batch they sold, or does that reflect a real shift in their pricing power?
That is the necessary critical question. And while the market's still volatile, the sustainability really comes from the operational context. Management isn't pausing. They're sticking to their aggressive forward guidance.
They reaffirmed the full-year target, right?
They did. The full-year 2025 production target of approximately 270,000 tons of concentrate. Hitting that target is the commercial proof point. It's what positions them as one of the world's leading pure-play lithium producers.
So scale and reliability are key. But for an investor, when does that scale actually translate into better margins?
We're looking at Q1 2026. The full ramp-up is targeted for the first quarter of next year. And they've been proactive, bringing in upgraded equipment, pushing towards that full capacity.
And hitting that Q1 target should improve margins just by spreading out the fixed costs.
That's the whole idea. It'll significantly improve margins by better utilizing all that heavy fixed infrastructure. The entire story of moving from negative earnings to, sustainable cash generation is built on hitting that target.
Okay, execution seems flawless. But a fast-growing miner, especially in a cyclical market, needs a bulletproof balance sheet. How's their financial foundation looking? Are they having to raise more money to fund this growth?
No, and that's a key measure of management quality here. They are laser-focused on self-funding and aggressive deleveraging.
Deleveraging, so paying down debt.
Exactly. Total debt is down to just over $161 million as of Q3. But what's really impressive is the type of debt they're tackling. They've cut the high-interest, short-term trade finance debt by 38% year-to-date. That's just smart strategic capital management. You reduce the most expensive obligations first.
Right. That frees up cash flow immediately. That's the difference between a sound growth story and one that's always on the edge. What about immediate liquidity? Mines are cash hungry.
Liquidity saw a huge improvement right after the quarter ended.
Yeah.
See, cash on hand looked a little low at the end of Q3, but then they rapidly converted their trade receivables.
So the money they were owed from sales.
Exactly. They turned that into immediate cash. This brought their near-term liquidity up to around $29 million. It provides a credible bridge to self-funded growth without going back to the equity markets.
Which is what every lithium investor is afraid of right now.
Absolutely.
And they also found this other revenue stream. I saw them talking about something called middlings. For you listeners who aren't deep in mining jargon, what are those?
That's a great question, because middlings sound like small change, but it's substantial here. They're essentially a lower grade, high purity byproduct, kind of like, industrial scrap or fines from the main process.
And how much cash does that generate?
They're anticipating generating $33 million from selling about 950,000 tons of it.
33 million.
And it's a non-dilutive, almost zero-effort source of cash flow. Their clients can reprocess it, and the company gets a check for $33 million without any new capital spending.
So they're shoring up the balance sheet, finding creative cash. But we have to talk margins. The lithium prices just crushed some of their peers. What's the secret weapon here?
Their cost structure. It is the single most important factor. They have a moat. This is it.
How good is it?
They are positioned as one of the lowest cost hard rock producers globally. Their Q2 2025 cash operating costs were $442 per ton delivered.
$442.
Which is 12% below their own internal target of $500.
12% below target. In this inflationary environment, that's just astonishing operational discipline.
It really is. And if you look at the bigger picture, their all-in sustaining cost, the AISC, which basically everything needed to keep the mine running, averaged $594 per ton.
So under $600 all in.
Right. If that's their cost, they are selling champagne at beer prices compared to most of their peers. This low-cost base is why they can maintain a positive gross margin when others can't.
And you can see that low-cost structure in their profitability path, right? Even though they're still pre-break-even, those EBITDA losses are narrowing fast.
That's right. Those losses improved 64% sequentially in Q3. That's not a slight improvement. That is setting the stage for very high operating leverage.
Operating leverage is the key phrase.
It is. It means that if or when the lithium price recovers even a small amount, the jump in profitability for this company could be absolutely outsized compared to higher cost producers.
Okay, let's pivot a bit, away from pure financials. Let's talk competitive advantages that don't just show up on a quarterly statement. The sources keep highlighting something unique about this company, their ESG credentials. What is their moat here, and why should a big car company care?
This is where their strategy really sets them apart, especially for those Western OEMs and battery makers. They operate under what they call the quintuple zero ESG model.
Quintuple zero. Okay, that sounds like a great marketing slogan, but what does it actually mean? Is it measurable?
It is. It's an operating framework with 5 measurable zero impact points. So zero tailings, which means no mining wastewater, 0 hazardous chemicals, 0 freshwater use, 0 carbon emissions in their process, and 0 social harm.
And this isn't just talk.
No, their processes, they include electric-powered crushing and solar-assisted leaching. It all results in measurably lower CO2 emissions per ton than, say, their Australian hard rock competitors.
So this is a major selling point for OEMs who are under huge pressure to decarbonize their entire supply chain. They need low-carbon, ethically sourced lithium.
Precisely. This positions them as a global ESG leader in lithium, which is a powerful advantage, especially with the EU focusing so heavily on how their critical raw materials are sourced. It's a commercial imperative for those buyers.
And their location in Brazil adds another layer of security, right? A non-Asian supply alternative.
Absolutely. In the current geopolitical climate, that is crucial. It helps mitigate risk and support supply chain diversification, which is probably the #1 concern for the entire auto industry right now. They need guaranteed supply.
And I assume they lock that in with their contracts. Are they structured to protect them from the boom and bust price cycles?
They are. They've secured long-term offtake agreements with Tier 1 EV battery makers. And critically, these contracts often have price escalators built in.
Look what?
We're talking clauses like CPI, the inflation index, plus an additional 2% annually. This provides a reliable, growing revenue base that insulates them from the worst of the spot price volatility. They're future-proofing their margins.
Okay, we've laid out a pretty compelling growth story. Low cost, ESG moat, strategic position. But we have to address the risks. What could challenge this bullish narrative?
Right. This raises the important question. What could reverse this momentum? And based on the analysis, we see 2 main risks you need to track: commodity price volatility and customer concentration.
Let's start with the lithium price. I mean, for all this operational excellence, the market is still weak, and the company is still reporting negative EBITDA.
That is the core risk. their overall profitability remains highly sensitive to the lithium price environment. We saw it when they withheld product in Q2. Revenues dipped sharply. You are, at the end of the day, betting on price stabilization at a minimum.
So what's the mitigation for that besides just hoping the price goes up?
The mitigation is primarily in that cost advantage. That sub-$600 all-in sustaining cost provides an immense buffer. It means the floor for their business is just so much lower than their competitors. They have high leverage to the upside while being cushioned on the downside.
What about customer concentration? Relying on one big buyer is always a red flag for me.
And historically, it has been high. In some recent quarters, as much as 94% of their revenue came from a single customer.
94%.
Yeah. So if that relationship sours or that customer had their own production delays, the company is massively exposed.
So how are they addressing that vulnerability?
They're actively negotiating with new buyers. Management has signaled this, and there's significant interest from large European buyers who are really keen on that quintuple zero certification. Plus, they have contractual penalties in place, which suggests the risk is manageable as they work to diversify.
Now let's talk about the stock itself. The market seems to be reacting very aggressively to this story, despite these risks.
It absolutely has. The stock has shown extreme upside momentum. The sources point out it doubled in a single month in late 2025.
Doubled in a month.
Yeah, that kind of action, surging 15% on some days, that screams that institutional and momentum money is rotating in fast.
And that kind of move is fueled by catalysts. What should you, the listener, be watching for over the next 3 months?
We have some hard catalysts on the calendar. The Q4 2025 earnings report. That's expected around mid-January 2026. Then the full-year update in mid-February. Those reports have to confirm that this revenue is sustainable and that margins are healthy as they head into that Q1 full ramp-up.
And what about the institutional money flows? That can often drive near-term trading.
That's right. The institutional disclosures, the 13F and 13G filings, are expected toward the end of December. These will show us what the big hedge funds are buying and selling. We also have index rebalancing events in late November, which can force big ETFs to adjust their positions.
And what about the more speculative stuff, the rumors and chatter that can drive outsized moves?
Well, there's persistent market speculation, unconfirmed of course, about potential strategic acquisition interest. A global battery or mining giant looking to buy this kind of high-quality, low-cost asset.
That would be a major re-rating event. What else?
There's also chatter about new, expanded supply contracts with major EV makers, which would solve that concentration risk overnight. And finally, some discussion in Brazilian media about potential government incentives or subsidies for lithium producers.
So if you put it all together,
If we synthesize this whole story, what you have is a company that has navigated that transition from build-out risk to operational scale. They're managing their debt, and they're sitting on a huge structural cost and ESG advantage.
and the only major thing holding it back is the short-term lithium price.
Exactly. What this means for you, the investor, is that the company seems to offer asymmetric upside potential. The reward appears to outweigh the manageable known risks. When lithium prices stabilize, that high operating leverage kicks in, and the earnings inflection could be dramatic.
Turning a successful miner into a profitable powerhouse. That structural advantage makes this a fascinating look at how operational excellence can conquer macro headwinds.
It really does.
If you enjoyed this analysis of the sources, remember to subscribe, like, and let us know what company or topic we should examine next.